You missed a credit card payment by one day, just one day, no warning, no phone call, no dramatic moment. Nothing exploded, nothing felt urgent. Life simply moved on. But somewhere in the background, something changed. A system noticed, a database updated, a record was marked, and that single late payment quietly triggered a chain reaction, one you won't see, one no one explains, and one that can follow you for years. This is why it sucks to be late on a credit card payment. Not because of the late fee, not because of the inconvenience, but because of what happens after that moment, silently, automatically, and without mercy. Stay with me, because by the end of this video, you'll understand why the system reacts so harshly to being late, and why it was designed to behave this way from the very beginning. What people think happens. Most people think missing a credit card payment is simple. You forget the due date. You pay a late fee. You promise yourself it won't happen again, and then you move on. That feels fair. People forget things. Life gets busy. Bills overlap. Mistakes happen. You assume the system understands that. But the credit card system doesn't think in terms of excuses or context. It doesn't know if you were sick. It doesn't know if you were traveling. It doesn't know if your paycheck arrived late. It only knows one thing. Was the payment received on time or not? That single yes or no answer is enough to change how you are evaluated. Because the system doesn't treat lateness as a mistake. It treats it as a signal about reliability, a signal about predictability, a signal about future behavior. And the moment that signal changes, your profile changes with it. The late fee is not the punishment. Yes, there is a late fee, usually somewhere between $25 and $40. That's the part everyone notices first. It's annoying, but it feels manageable. Many people assume the late fee is the punishment, but it isn't. The late fee is just the receipt. Behind the scenes, internal systems are already responding. Your account status updates, your payment history changes, your risk profile adjusts. Not because someone decided to punish you, but because the system is programmed to react instantly. There is no waiting period. There is no built-in forgiveness. The moment a payment becomes late, a process begins. And once that process starts, it does not reverse itself just because you catch up. What actually happens inside the bank? Inside the bank, a missed payment triggers a multi-step internal process. First, your account is reclassified, not publicly, internally. You move from normal account behavior into a monitoring category. This category determines how often your account is reviewed, whether automated alerts are triggered, whether your credit limit is considered stable. At this stage, no human is involved. Everything is algorithmic. The system doesn't assume you're irresponsible, but it assumes uncertainty has increased, and uncertainty must be priced. The invisible 30-day line. Here's something most people never realize. Being late doesn't matter equally at all times. There is an invisible line, the 30-day mark. If your payment is late by a few days, you'll usually face fees and interest penalties. But once it crosses 30 days, it becomes something else entirely. It can be reported to the credit bureaus. And once that happens, it becomes part of your permanent financial history. This is where the real damage begins. Because when a late payment is reported, your credit score doesn't gently dip. It drops. Sometimes by 40 points, sometimes by 70, sometimes even more. And here's what surprises most people. If you had good or excellent credit before, the drop is often larger. Why? Because the system expects consistency. Someone with strong credit who suddenly misses a payment looks unpredictable. From a lender's perspective, predictability matters more than effort. Therefore, reliability becomes risk. Why credit limits sometimes get reduced? Many people notice something strange after a missed payment. Their credit limit goes down. Not immediately, not with a warning, just quietly. This happens because credit limits are not rewards. They are risk exposure allowances. When you miss a payment, the bank doesn't want to lend you more money, so it reduces its exposure. That reduction can increase your credit utilization, trigger another credit score drop, make future payments harder. This is how one late payment can cause secondary damage, even if you never miss again. Why one mistake lasts for years. Let's say you fix everything immediately. You pay the balance, you bring the account current, you never miss another payment again. You assume the system resets, but it doesn't. That late payment can remain on your credit report for up to 7 years. 7 years. Not because you're still late, not because you're still risky, but because the system values history more than intention. Lenders don't just want to know what you're doing now. They want to know what you've ever done. And the system assumes past behavior is the best predictor of future behavior. How credit bureaus interpret late payments. Credit bureaus don't track morality. They track patterns across millions of people. When they see a late payment, they don't ask whether it was understandable. They ask what usually happens next. Statistically, late payments correlate with higher default rates, higher bankruptcy risk, higher charge-offs. So your late payment doesn't stand alone. It joins a historical data set, and your score adjusts based on how people like you behaved after similar events. That's why recovery feels slow. You're not judged as an individual, you're averaged into a group. The interest rate penalty. Now comes the part that quietly costs the most money, your interest rate. Many credit cards include something called a penalty APR. Miss a payment, and your interest rate can jump dramatically. 25%, 29%, sometimes higher. And even after you start paying on time again, that higher rate can stay for months, sometimes indefinitely. Every purchase now costs more, not because your spending changed, but because borrowing itself became more expensive. Why even old late payments still affect loans. Even years later, lenders can still see the impact, not always directly, but indirectly. Many lenders use custom scoring models. These models look at how many late payments occurred, how recent they were, what type of account they happened on, whether they occurred during stable income periods. So even if your score recovers, your profile may not. This is why two people with the same score can receive very different loan offers. Why the system doesn't warn you better. A natural question is, if this is so serious, why doesn't the system warn people better? The answer is uncomfortable. Warnings reduce penalties, and penalties are profitable. Late fees generate revenue. Penalty interest generates revenue. Extended balances generate revenue. The system is optimized for response, not prevention. That's why reminders are passive, but penalties are automatic. Why banks designed it this way. Banks didn't design this system to be kind. They designed it to be predictive. From their perspective, a late payment is one of the strongest indicators of future default. So the system reacts early, fast, and aggressively. Higher interest rates compensate for higher risk. Lower credit scores reduce exposure. Tighter approval standards limit losses. The system isn't emotional, it's mathematical. The snowball effect. A late payment lowers your credit score. A lower score raises your interest rates. Higher interest makes balances harder to pay down. Harder balances increase the chance of being late again. The system doesn't slow this down, it accelerates it. Because it's not designed to help people recover. It's designed to price risk accurately. Why it really sucks. So why does it really suck to be late on a credit card payment? Not because you're irresponsible, not because you failed. It sucks because the system reacts faster than humans do. There's no conversation, no explanation, no context, just triggers, flags, consequences. Ending. Last dab. A missed credit card payment isn't a moral failure. It's a signal, and the system treats signals seriously. That's why it sucks. Not because of the money you lose today, but because of the doors it quietly closes tomorrow. Understanding the system doesn't make it kinder, but it makes you smarter inside it. And this is why so many people feel confused by the credit system. They do what they believe is right, they pay when they can, they fix mistakes quickly, but the system does not reward effort, it rewards patterns. Once you understand that difference, credit stops feeling personal and starts feeling mechanical. And that understanding alone changes how you see every financial decision.